In this video, I intend to cover everything that you need to know about the efficient markets hypothesis, and I'm making this video specifically for my series on actuarial economic modeling, although if you are covering this topic elsewhere, it should also be relevant. Okay, so what is the efficient market hypothesis, and what is the mechanism by which markets move? Okay, so the efficient market hypothesis in a nutshell is essentially saying whether markets are priced in a way that is accurate. So a market whose prices are accurate immediately is an efficient market, and a market whose prices are never accurate would be an inefficient market. Okay, and then the mechanism by which markets move is supply and demand. So when information comes into being, this can create a higher demand for that particular asset. So for example, a company has shares that are listed on a stock exchange, and if there's good news about this company, the demand for this company's shares increase, and so the prices increase. And so that's a reaction of the market to that news, to that information. And so if you have many people in the market, this could make a market more efficient since there's more trading. But that's not a necessity. You could just have, for example, many or few people in the market, but all trading very actively. That could also make a market more efficient. So the point is the volumes of demand and supply of trades. Okay, and that can really dictate where the markets move. So another market might have more demand than a previous market, but if the supply is way greater relatively than the demand was, then it might still be relatively more inefficient. Okay, because there's not as much trading per asset in that market. So markets move by supply and demand, and this supply and demand is directly affected by investor sentiments, and investor sentiments are directly affected by information that comes into being. Okay, now what are the consequences of efficient and inefficient markets? Well, I said that an efficient market, so the efficient market hypothesis says that markets are efficient. Now, an efficient market is one in which prices are accurate, and they're accurate immediately. Now, the consequence of this is that active investment, so investment that actively seeks to take advantage of mispricings, is not possible. Okay, so when a market is efficient, active investment to generate excess risk-adjusted returns is not possible. Now, you can still achieve, now I'm talking about this point concurrently, you can still achieve excess returns through active investment even in an efficient market, a market which is priced completely accurately. And the way that you would do that is if the returns are not risk-adjusted excessive. So, for example, let's say you were investing in shares, and you thought that some shares were underpriced, and so you invested in them, and then you thought because they're underpriced, the market's going to correct, the prices will go up, and I'll see excess returns because of those prices going up, as well as them growing at their natural rate. But I'm expecting them to grow above that because they're currently underpriced. That's what someone expects. But let's say they were actually correctly priced, but there's some fluke that happens that no one could have known, that wasn't priced into the market, and that ended up resulting in the shares increasing in value. So no one knew this in advance, and this wasn't information that could have been priced into the market. So it's not that it was inefficient, it was efficiently priced, and So you can't say that you actually exploited a mispricing. It's just that new information came about, and due to an extra risk that you took, you bought a stock that you thought was underpriced, but it was actually correctly priced. And so you did achieve excess returns, but it wasn't risk-adjusted excess because it wasn't actually underpriced. So it could have equally likely have happened the opposite direction, where bad news could have come about and the share price could have dropped instead of good news resulting in an increase in the share price. So risk adjusted is so important because we need shares, or we need our markets returns to be above the rest of the market. So we need to produce returns, active investment, to produce returns that are risk adjusted above the market. And that can prove that a market would be inefficient. So if a market is efficient, then it is not possible to generate excess risk-adjusted returns. That's the most important sentence. Okay, if a market is efficient, it is not possible to produce excess risk-adjusted returns. Okay, so I don't feel like I've fully finished this point yet, though. So the consequences of an efficient market is active investment is not possible. Active investment is seeking mispricings in order to generate excess risk-adjusted returns. Okay, inefficient markets, the consequences of inefficient markets is that there are mispricings to exploit, and so you can use active investment in order to generate excess risk-adjusted returns. Now, if you can't use active investment, such as in an efficient market, then what you rely on is passive investment. And the reason why passive investment still works is because you're relying on the underlying growth of the asset, the underlying increase in economic value of the asset. And so as that grows, as a business actually becomes more valuable in the marketplace, returns increase, okay, or you produce returns. Okay, so that is returns that are reduced from passive investment, and passive investment is warranted in efficient and inefficient markets, but you could produce excess risk-adjusted returns above the market returns which you get from passive investment in an inefficient market through the use of active investment, but only if that market is inefficient. Okay, now, do we consider transaction costs in this? So you might be saying that it's all very well and good to get your excess risk-adjusted returns, but what happens if after I take into account transaction costs, now these trades that I'm making no longer give me those excess risk-adjusted returns? So this is up to the individual, and there's no right or wrong answer. Now you would just have to specify. Some traders, some investors include transaction costs in their definition for efficient market hypothesis, and others exclude it. So it's really a personal decision, but it seems to make practical sense to include transaction costs as a consideration, because at the end of the day, a trade is only made possible through actually transacting, which does incur transaction costs. So theoretically, we might exclude transaction costs to assess whether there isn't a mispricing in the first place. But once we actually take account of the costs that we need to incur in order to exploit that mispricing may no longer be able to generate excess risk-adjusted returns for us. And in that case, then we say that transaction costs are material. So in a practical sense, transaction costs should be taken into account, but theoretically, we would exclude them if we just want to assess whether mispricings exist in the first place or not. Okay. Now, what is the weak form efficient market hypothesis. So the weak form efficient market hypothesis states that market prices incorporate all price history information. So what that means is that technical analysis cannot be used to produce excess risk-adjusted returns. So what I've essentially said here is that if you were to look, in a weak form efficient market would be one where if you were to look at the past history of the prices in that market, you wouldn't be able to find any patterns that you could use to predict future changes in prices, so future price movements. And if you could, say, for example, predict something that has occurred regularly in the past that you could expect to occur again, then you've found a mispricing because the prices do not account for that pattern. And it should account for that pattern. In other words, other people in the market should recognize that there is a pattern in the price history. And if other investors recognize that there's a pattern in the price history that's likely to repeat itself again, you would expect them all to act on that. And if they all act on that, they actually move the prices back to the correct price, and which eliminates that inefficiency, which eliminates that mispricing. So for example, if the closing price on a Friday is always higher than the closing price on a Thursday, then everyone in the market will buy on a Thursday and sell on a Friday. But what happens then if everyone is buying on a Thursday is it drives the prices up. And if everyone is selling on a Friday, it drives the prices down, and it eliminates that discrepancy that you've always seen in the past. So if a market is weak form efficient, then you can't find patterns like that in the price history. And so just by looking at the price history information, the chart, so chartism or technical analysis, you can't produce excess risk-adjusted returns just by looking at the price history. There's no patterns to exploit. There's no patterns in the price history information. Okay, so the consequence then of weak form efficient market hypothesis is that second point that I said, which is that technical analysis cannot be used to produce excess risk-adjusted returns. So what is the semi-strong form efficient market hypothesis? The semi-strong form efficient market hypothesis says that market prices incorporate all public information. Okay? Then the consequence of this is that markets that are semi-strong form, investors cannot use fundamental analysis to produce excess risk-adjusted returns. So fundamental analysis is looking at things like your accounting ratios. So if an investor were to look at the accounting ratios and see that a certain accounting ratio should indicate that there's going to be high growth in the future, then if they were to then act on that in a semi-strong form efficient market, if they were to act on that information, they wouldn't be able to produce excess risk-adjusted returns. So they may produce excess returns randomly or by taking on more risk, but they can't produce excess risk-adjusted returns in a semi-strong form market by looking at accounting ratios, by using fundamental analysis. Okay, so a market that is semi-strong form efficient means that any information that becomes publicly available is immediately incorporated into market prices, and it's incorporated accurately immediately. So as financial statements are released, as the CEO gives a speech, as there's a controversy in the media, whatever happens, as that happens, the consequence of that on the share price happens immediately, and it happens accurately in a semi-strong form efficient market. A market that is not semi-strong form efficient could be one where, for example, there is the release of information to the public and the market doesn't react accurately and immediately. So a market that reacts, let's say, accurately but not immediately, so it reacts but it takes time to react, or it overreacts and then it has to correct, this is not semi-strong form efficient. Okay, so what is a strong form efficient market hypothesis? So this is where market prices incorporate all information, and all information being public and private information. So semi-strong form was just public information. Strong form is now public and private information. And weak form, just to remind you, that was price history information. Okay, so strong form information is all information now. So it's the price history, it's public information, and it's private information. And just to be clear, semi-strong form was public information, and public information included the price history information, which is the basis for our weak form efficient market hypothesis. Okay, so getting back to the strong form efficient market hypothesis, I said it was where market prices incorporate all information. Okay, now the consequence of this is that a strong form efficient market, investors cannot use insider trading in order to produce excess risk-adjusted returns. Okay, so essentially understanding this, a strong form market, as information comes into existence, is known by anyone, whether that be the CEO only, anyone internal to the company, which is where this information typically comes into existence in the first place anyways. But so when it comes into existence and only someone inside the corporation knows that information, the markets should react immediately and it should react accurately. And if it does so, then a market would be strong form efficient. And as you can imagine, that's quite a harsh criteria, and no markets are typically strong form efficient. And just a typical thing is that insider trading is prohibited. And so if insider trading is prohibited, then how could you expect a market to react immediately when insider information becomes available and accurately? It's just unrealistic unless there is illegal activity where someone is acting on insider information. Okay, but yeah, so strong form efficient market hypothesis, as any information comes into existence, but now we're particularly looking at what we added onto from the requirements of semi-strong form, is that private information. So even when private information comes available, the market should react immediately and accurately. Okay, and then you can't use insider trading to produce excess risk-adjusted returns. So if there were to be some information that comes available, and then you, as an insider to that firm, went and acted on it immediately, you would not be able to produce excess risk-adjusted returns in this strong form efficient market. Okay, so this question you should be able to answer yourself based on the definitions and based on what information is incorporated in market prices of weak, semi-strong and strong form. You should be able to answer this, so try and do it yourself. Is a strong form efficient market also weak form efficient, and vice versa? Okay, so let's think about it. So a strong form efficient market, I said, incorporated market prices incorporate all information. A weak form efficient market, market prices incorporate only the price history information. Okay, well, a weak form efficient market then can also be strong form, but it's not necessarily strong form. So the only criteria for a market to be weak form is that price history information is incorporated. But it doesn't say anything about public information and insider information. Okay, so a weak form efficient market can be strong form, but it's not necessarily strong form. Now, what about a strong form market? Well, a strong form market incorporates all information. That means it incorporates the price history information. That means that technical analysis cannot be used to produce excess risk-adjusted returns. So that means that a strong form efficient market is, in fact, also weak form efficient. So if a market is weak form efficient, it is not necessarily semi-strong form, and it is not necessarily strong form. However, if a market is strong form efficient, then it is necessarily semi-strong form and weak form. So it's scaffolded in that way. A strong form market is always a semi-strong form market, is always a weak form market. A weak form market is not always semi-strong form, is not always strong form. Okay. Now, what are the two things a market needs to demonstrate for it to be efficient? You should also be able to answer this question. Maybe the question is not so clear, but you will have this information based on things that I've told you so far in this video. So the two things that a market needs to demonstrate for it to be efficient is, one, that market prices should react immediately to new information, and two, they should react accurately to new information. So an efficient market is one in which, as information comes into existence, market prices react immediately and they automatically correct to the correct price, the exact correct price. There's no overreactions, there's no underreactions to information, and there's no delayed reactions to information. It must react immediately and correctly. Okay. Now, tests of weak form, strong form, and semi-strong form efficiency. Okay, so if we want to look at a particular market and we want to assess whether this market is weak form efficient, then all that we have to do is to look at the price history information and try and identify any patterns that exist. So things like the prices on Fridays, closing prices on Fridays are always higher than closing prices on Thursdays. Or things like markets mean revert, or markets have short-term momentum. That's a pattern. Okay, so markets that are increasing in the short term are likely to continue increasing, which is actually true in reality, and it is evidence against the weak form efficiency. And so is mean reverting markets, so markets that way overreact and then correct later, or that underreact and then correct later, but typically overreact and then correct later to the correct, to a more neutral growth. That would indicate that markets aren't weak form efficient, and typically we do accept that markets mean revert and that markets exhibit short-term momentum. So short-term momentum and medium-term mean reversion. So there is evidence against weak form efficiency, and there is evidence for weak form efficiency. So typically technical analysis has produced returns that are no better than random stock picking. And so that would indicate that markets are, in fact, weak form efficient. Now, of course, it depends on the market. We can't blanketly say that markets are weak form efficient or markets are strong form efficient. So for example, the New York Stock Exchange or the Johannesburg Securities Exchange are much more likely to be an efficient market than, say, the second-hand market for cell phones in a township, say. Okay, it's much more likely that there are going to be mispricings, that cell phones are going to be sold at prices that do not truly reflect their actual value. Okay, so a second-hand cell phone market is much less likely to be efficient than the New York stock market. Okay, so the point that I was making here was about weak form efficiency, and that not all markets are necessarily going to be weak form efficient or not. So it depends on the particular market, but we generally do accept that markets are weak form efficient, and typically we refer to the stock markets when we make that assumption. So we make the assumption that typically technical analysis cannot be used to produce excess returns. Okay, now tests of the strong form efficient market hypothesis run into obvious problems that in order to test it, you actually have to have the insider information. Now, you can't really have the insider information because it's private information. And so the very fact that you would then know the private information would defeat the fact of it being private information. And now it would no longer be private information, it would be public information, and you wouldn't even be testing the strong form efficiency thereafter anyways. So first of all, it's difficult, legality, to get your hands on this private information. And then you actually have to assess whether or not the prices incorporate that private information or not. And you would then have to have a true picture of the value of the assets in the market. And none of these are feasible things to know. And so it's pretty much impossible to test strong form efficiency. However, we do generally accept that markets are not strong form efficient. And that's just by virtue of the fact that insider trading is illegal. Okay? So how could they be strong form efficient if people who have this inside information are not actually allowed to act on it? Okay? So typically we reject that markets are strong form efficient. However, we can say that directors, it's been shown, there's evidence that directors do not produce or do not have returns that are any better than the market on average. Okay, so that would suggest that markets are strong form efficient, but it could just be that these directors are not actually allowed to act on any insider information, not trading on other assets within the market, and so therefore their returns aren't going to be excessive anyway, risk adjusted excessive. So we still generally reject strong form efficiency of markets. Okay, now testing the semi-strong form efficient market hypothesis is a much more complicated task, and it's actually one where there's not much consensus. So you'd probably be equally likely to find someone who says that markets are semi-strong form efficient as you would be to find someone who says markets are not semi-strong form efficient. And of course, once again, it does depend on the market that you're looking at. Okay, so evidence of overreactions and underreactions point to markets not being semi-strong form efficient. So typical overreactions are to past performance. So past winners tend to be future losers, and past losers tend to be future winners. So this is typically overreaction. So for example, people might benefit in the short run by an overreaction to an event and then in the long run, their returns are brought back to average. Or someone might be punished in the short term, but in the long run, things correct, and they're actually brought back to average again. Okay, so those are overreactions initially to events, and then a correction later on. Okay, so past performance, past winners are future losers, and vice versa. Okay, and then certain accounting ratios also appear to have predictive powers, which would suggest that there are overreactions to certain information, because that information that is coming up in the accounting ratios shouldn't have any effect on prices. It shouldn't be predictive. They shouldn't have predictive powers. And so the fact that they do have predictive powers is the market overreacting to that particular information coming into existence. Okay, and then firms coming to market, so this is IPOs and equity offerings. These things are typically viewed too positively by the market, and the market tends to react too positively to this information. Okay, and that's an overreaction, and then they tend to correct over time. Okay, and then there are also underreactions to events. So just as an overreaction leads to a market being inefficient, so does an underreaction. So an underreaction is something like a earnings report being released, and then up to a year later, which is known to happen, markets are still reacting to that same earnings report. Okay, that's an underreaction. They're taking long to react. Okay, then following demergers, the market typically fails to recognize the benefits of a demerger. So they overreact to mergers and acquisitions. They tend to see these as more positive than they are, and they tend to see demergers as less positive than they are. So they underreact to demergers and they overreact to mergers. Okay, those are reactions again of overreaction and underreaction, which suggests that markets are not semi-strong form efficient. And then so this is informational inefficiencies that are leading to mispricings in the market due to slow reactions. So slow reactions as in reactions that happen, but happen only to get to the correct prices over time, and that's because they either overreact in the first place or they underreact in the first place and then have to course correct later on. So that's evidence of a market that is not semi-strong form efficient. And typically we do see overreactions and underreactions, such as the examples that I gave you. Okay. Now, there are also volatility tests to test semi-strong form efficiency. So the essence of a volatility test is that if you could look at the volatility of market price history, and then you could go and look at the volatility of, if you could get the perfect prices such that, like the perfect value over time, and instead of having, you have a graph for the market prices, you get the volatility out of that graph, and then you get the market out of the true values, and you get the volatility out of that true value graph. Now, if those volatilities are different, statistically different, you would say that markets are inefficient. And you would see that our market prices are more volatile than our perfect prices, our true values of the asset. So if the market prices are more volatile than the assets, that is an indication that people overreact and underreact and there's herd behavior, herd mentality. There's all these things that are going on as a result of the mechanism by which market prices move, being supply and demand, which is underpinned by investor sentiments. And investors are inherently irrational. Okay, investors are humans, and humans are irrational, or not at least completely rational. And so any volatility in the market is accentuated by humans reacting to information. And so if a market is more volatile in reality than it is than the underlying truth of that value represents, then that is evidence of semi-strong form inefficiency. Okay, so the way that volatility can be tested is what Shiller did. So what Shiller did was he found perfect prices, theoretical perfect prices, and he did this by looking at dividends that were actually issued in the past and using a dividend discount model, cash flow model, as well as a terminal value for the stock. And he discounted all of this to each point in time, and he got theoretical values for that stock at each point in time. And then he compared those values with actual market history. And then he found that the market prices were more volatile than his theoretical perfect prices. Okay, now this is not a perfect test, and it suffers from the joint hypothesis problem. And the joint hypothesis problem says that it's impossible to know whether the result, the conclusion of Shiller's volatility test, indicating that markets are inefficient, it's impossible to know whether markets actually are inefficient or whether Shiller's model was just inaccurate or relied on false assumptions. So it's impossible to know whether his assumptions are wrong or whether the market is actually inefficient. So even if you conclude something based on these volatility tests, you can never be completely sure about your conclusion because of this joint hypothesis problem. You don't know whether your conclusions are because of your incorrect assumptions or because of the market truly being inefficient. Okay, so that leads to a lot of criticisms of Shiller's volatility tests. And the main criticisms were that Shiller had to subjectively specify a terminal value for the stock price in his dividend discount model. So he discounts the dividends, but he also has to have some terminal value. So even if he used a dividend in perpetuity model, he still has to specify future dividends subjectively because they have not happened yet and they're not guaranteed. So he would have had to specify those, or alternatively, which is just the same as specifying a terminal value. And if he used the market prices, that's still not effective because the market price could be wrong. The whole thing is he's trying to test the market price. So he's trying to use a true terminal value, but there's no way to actually have a true terminal value. So that's one of the criticisms of Shiller's test. Another one is that he used a constant discount rate in order to present value all those dividends and his terminal value. And we know that interest rates typically are not flat over time. That's why we have yield curves. So we typically expect interest rates to change over time, and so we can't actually make that assumption to use a constant discount rate. And then there's also bias in estimates of the variances due to autocorrelation. So these values year on year are actually correlated, and so there might be bias as a result of that, which is throwing off his conclusions. And then also non-stationarity. So it might have stochastic trends which invalidate the measurements of the variance which he obtained. So he might have made assumptions of stationarity, but now the market prices actually inherently aren't stationary, and so that is also another problem with the Schiller test. Okay, so everything that I've said to you now should cover you for all the understanding that you need for efficient market hypothesis questions, and typically you'll be given scenarios, and so it's really important that you test your understanding by seeking out these scenario questions and seeking out examples and applying your understanding. So the things that you will typically be asked are these questions on what the definition of weak form, semi-strong form, and strong form, and the consequences of all of them in terms of which type of trading does not produce excess risk-adjusted returns. So those are typical questions, and everything else is kind of understanding. And then another typical question is on testing semi-strong form efficiency, and then lastly is applying all this understanding to scenarios. So make sure you know how to do that.